Welcome to the deep dive. Today, we're really digging into some big questions you sent our way. We've got a fascinating stack of sources here, articles, notes, research, all touching on, well, the heart of our economic system and maybe where it's heading.
That's right. And our mission, for this deep dive is to get right inside that material you provided. We want to unpack those concerns about the Federal Reserve, maybe explore that intriguing theory about a certain high-profile feud.
Yeah, and also investigate how AI might simulate some really radical economic shifts, and then confront that challenging reality of the U.S. national debt.
Exactly. We're going to pull out the most important insights, those little nuggets of knowledge from everything you shared, and really help you understand what might be going on here.
Okay, let's unpack this. First topic, the Federal Reserve. The material you sent really highlights this, well, it's a long-standing debate, isn't it, about the whole system?
It really is. And the core criticism that jumps out from the sources is this idea that money, under the current setup, isn't tied to physical value like gold was.
Right.
Instead, it's mainly created through debt. Essentially, the Fed buys government bonds. And critics argue that this process, they call it monetizing the debt, is basically the engine driving inflation. It's why currency loses value over time.
And your sources give a really stark example of that, don't they? Mentioning that $1 back in 1913
when the Fed started
is worth only about, 3 cents today? That's just the cumulative hit from inflation managed under this system.
It's pretty staggering when you put it like that.
Yeah.
And so the arguments for, ending the Fed, which you see reflected in some of the material, like sentiments from @Rep. Thomas Massey on X, they boil down to wanting to stop this debt-based money creation to, curb inflation. Maybe return to something like gold for stability and get rid of the centralized power held by this unelected board.
Okay, but here's where it gets really interesting, because the material you sent leads directly to this critical concern you raised. Is ending the Fed actually feasible, or would trying it be like financial suicide for everyone?
That is such a crucial question, and the sources definitely agree it's a valid one. I mean, the global economy is just so deeply integrated with the current system.
How so? What's the big risk?
Well, the chaos potential comes from the fact that almost all wealth, think about it, savings, investments, pensions, it's all tied up in fiat currency. So trying to just flip a switch overnight, your material suggests it could completely freeze markets.
Wow.
Disrupt global trade on a scale we've probably never seen, and potentially cause a massive worldwide spike in unemployment.
Yeah.
The potential fallout is huge.
And the research you shared seems to argue pretty strongly that there isn't really a clear alternative ready to go, right? Whether it's gold or crypto, they're just not set up to handle that global scale without causing, massive uncertainty and maybe a total loss of confidence.
Exactly. The sources mentioned the U.S. going off the gold standard back in '71. That caused some short-term bumps for sure, but the system stabilized because the dollar was already the world's main reserve currency. Trying to dismantle the current system where the dollar is that foundation, that's a whole different, much riskier ballgame, according to this material.
So it sounds like the sources acknowledge the criticisms, but also point towards maybe a middle ground?
Yeah, they do explore that. Maybe reforming the Fed, putting in much stricter oversight, or looking into developing some kind of digital currency that could be tied to actual tangible assets. The idea there would be to tackle that persistent inflation. The material notes it's been around, 2-3% annually based on recent CPI data, but without triggering, complete economic meltdown.
Okay, so pulling together everything you shared on this, what's the takeaway? It seems like the system, the Fed, while it gets a lot of criticism from different angles, it's just incredibly embedded globally.
Deeply embedded.
And the material strongly suggests that trying to just rip it out carries these immense, maybe catastrophic risks that seem to outweigh the potential upsides the critics mention, at least for now.
That seems to be the consensus in the material provided, yes. Now, should we shift gears? Let's talk about something quite different you brought up, but maybe with its own kind of strategic disruption angle.
Yeah.
That public tension between Elon Musk and Donald Trump.
Ah, yes, the feud.
Yeah.
The material notes the sort of surface friction, right? Trump hitting Tesla subsidies, Musk tweeting jabs about Trump's policies.
Right. And their dynamic seems to have gotten, more complicated after the 2024 election. There were reports of some private alignment, but the public spats kept going, like Trump talking up traditional manufacturing versus Musk pushing electric vehicles.
And this is where your really interesting theory laid out in the material comes in. You suggest this public tension might actually be strategic. a ruse even.
Well, the material explores that possibility, yeah. The thinking is, if Musk appears to be at odds with Trump, maybe it eases pressure on Tesla from, say, liberal groups who might target the company because they see Musk leaning towards Trump. You mentioned boycotts.
Yeah, and the sources noted Tesla did face boycotts in 2020, 2024 from activists. So a public feud? Maybe that signals distance?
It could. And the analysis you shared finds the theory, well, plausible. Plausible partly because Musk does have a history of using PR strategically, tweets, moving markets, that kind of thing.
It's that contrast, isn't it? The reports of private alignment on things like AI deregulation, tax cuts, stuff mentioned in places like at Wall Street Silver's X-Feed.
Yeah.
That seems to clash so much with the public jabs.
Exactly. That's what makes the ruse idea compelling to explore.
So if it is a performance, what are they even arguing about publicly?
The material suggests that if it is a ruse, the specific arguments are just part of the show. It's likely a tactic.
No.
For Musk, maybe it helps maintain brand appeal across different political groups. For Trump, maybe it makes him look independent from, powerful tech figures.
Makes sense.
Based on those potential benefits, and let's face it, they're media savvy. The sources estimate maybe a 60% chance that this public dynamic is at least partly staged.
But it's really important to stress, and the material is explicit about this. There's absolutely no concrete proof, no smoking gun.
None whatsoever. It's plausible speculation based on behavior and context. Interesting, but speculation.
Okay, now connecting some dots here. The material hints there might be a subtle link between the Fed critique and this whole Musk-Trump dynamic.
Yeah, it's subtle, but the idea is both figures, in their own ways, kind of challenge centralized systems, right? Mm-hmm. Musk with decentralized tech like X, Trump often with anti-establishment talk. So a radical move like ending the Fed, it could align with a broader push for disruption.
But as you highlighted from the sources, the risks are just enormous.
Massive. And maybe the feud itself, whether intentional or not, kind of distracts from areas where they might actually agree, like deregulation, which could potentially include financial reforms down the line, though that's more reading between the lines of the sources.
Okay, this brings us neatly to another key question you raised. Can AI actually run simulations of these really radical economic scenarios? Like, what if we just ended the Fed, or went totally crypto, or backed everything with gold, or got rid of derivatives entirely?
Right, simulating the extremes. The material you provide is pretty clear that there's limited public data on any comprehensive AI simulation that covers all of those things together.
So not one big simulation exists publicly.
Probably not covering that exact combo, but the sources absolutely confirm AI. Or we're talking large language models. Deep learning is definitely being used more and more in economic modeling.
Like what?
Things like predicting crypto prices, which you see discussed in places like Science Direct,
Yeah.
or even specific monetary policy simulations. There was mention of a React-based one built with Claude 3.7 Sonnet, discussed on the Market Monetarist blog you included. So the tools are being built.
Okay, so if the tools are sort of there, how might AI, based on what's in the sources, try to simulate these huge hypothetical shifts? Let's start with ending the Fed.
Okay, so for ending the Fed, an AI could look at historical data from before the Fed existed, like pre-1913 US economy. Then it would plug in current stuff, crucially, the national debt, let's say $33 trillion in 2025. Simulators like the one mentioned in the Market Monetarist show AI can model complex things like money velocity.
How fast money moves around.
That's
correct.
And inflation expectations, what people think will happen. The potential outcomes an AI might spit out could range from, hyperinflation, maybe worse than the 70s, or potentially a really severe deflationary collapse, maybe like 2008, but amplified.
Sure.
You see echoes of the tension in X sentiment too, like from ad-ass perplexity ending. The Fed might cap debt, sure, but could also trigger serious economic contraction.
Okay, what about simulating a world that goes all crypto?
For that, the sources mentioned deep learning models already used for predicting crypto prices and spotting bubbles. And AI could simulate different adoption rates. Like what happens if transaction speeds get way better through layer 2 solutions, those faster lanes for crypto payments? The AI would have to grapple with current big hurdles, like Bitcoin speed, still only about 7 transactions a second versus Visa's thousands. And volatility, maybe Bitcoin hits $100 in 2025, but still swings wildly. Crucially, it modeled crypto's internal risks, leverage, derivatives, referencing things like the Celsius collapse in 2022.
Yeah.
And noting there's no Fed-like backstop.
No lender of last resort.
Precisely. Though that Forbes report you included about Trump's possible strategic Bitcoin reserve. An AI could model how government backing might boost institutional adoption. X sentiment is all over the place here, right? You've got bulls like at Michael Saylor versus skeptics like at Peter Schiff.
Definitely mixed. And simulating gold-backed assets, how would that work?
An AI could pull data from the actual gold standard era, say 1870s to 1933. It could also look at modern digital versions, gold-backed crypto, like Tether Gold mentioned in the material. The simulation would constantly have to balance stability versus rigidity, meaning gold is finite. That offers stability, maybe, but it can also choke off credit and growth, potentially leading to panics, like we saw pre-1913. The sources also bring in the global angle, countries like El Salvador using Bitcoin to dodge sanctions. Maybe gold appeals to nations wanting off the dollar standard. AI would also need to model the risks of holding the gold hacks, mismanagement things that could trigger runs, kind of like stablecoin risks.
And the last one, simulating ending derivatives.
Here, AI could look at pre-derivative eras, maybe pre-1970s economics, and also analyze modern DeFi markets, which the St. Louis Fed has studied. The simulation would weigh the pros and cons. Less leverage means potentially less systemic risk. Good, but you lose vital hedging tools, making markets potentially less efficient. Businesses couldn't easily protect against price swings. AI would have to model the huge impact on crypto too, since DeFi relies on derivatives for things like yield. Remember the seed collapse in 2022? That's a case study. Simulations would likely show more market volatility without those smoothing mechanisms.
Okay, so even if no single simulation combines all four publicly, based on what is being modeled and discussed in the sources, what do they suggest are the likely outcomes if we did try these radical shifts?
Well, based on the data and trends in your material, the simulated outcomes probably start with short-term chaos. Big market crashes from lost liquidity, lost hedging tools. Long-term, the possibilities diverge. Maybe crypto takes over if it solves its scaling and regulation issues, or maybe get gold-backed stability but with built-in limits on growth.
And the economy itself.
Initially, probably a sharp contraction. The sources suggest maybe a 10-20% GDP drop, drawing parallels to the 2008 crisis aftermath. Globally, the big impact would likely be the US dollar weakening significantly as the world's reserve currency, forcing nations to look seriously at alternatives like crypto or gold.
And the sources also highlight the challenges in even running these simulations accurately, right?
Oh, absolutely. Huge challenges. Limited historical precedent for these specific shifts. Immense complexity. And constant regulatory uncertainty. Like, what is the actual impact of Trump's proposed crypto reserve? That's a moving target. X sentiment, like from @Ask Perplexity, reflects this some optimism, but a lot of acknowledgement of the huge debt and management issues in any scenario.
Okay, let's tackle the final big one. The U.S. national debt. Under the current system, the question you posed is stark. Will it become unmanageable? Specifically, could the U.S. reach a point where it can't even pay the interest?
It's a heavy question. Your sources lay out the numbers. National debt around $33 trillion expected by mid-2025. That's about 120% of GDP, using the 2024 estimate of $27.6 trillion.
So you're owing $1.20 for every dollar the economy produces in a year. Puts it in perspective.
It does. And the cost to service that debt, the interest payments are climbing fast. The CBO estimated $892 billion for 2024. That's about 3.2% of GDP, up sharply from $659 billion the year before, mainly because interest rates went up.
So when the sources talk about the debt becoming unmanageable, what's the actual definition they're using?
It essentially mean reaching a point where the government can't make its interest payments without doing something drastic,
right.
Like defaulting highly unlikely, but theoretically possible, or imposing really severe austerity measures that could cripple the economy, or the other option, triggering hyperinflation by printing tons of money.
Okay, and what are the key factors driving whether it stays manageable or tips over, according to the sources?
Several big ones. First, the debt to GDP ratio itself. 120% is high, but not unheard of. But the CBO projects it hitting 140% by 2030 if trends hold. Now, a high ratio can be okay if your economy grows faster than your borrowing costs. Japan's often cited huge ratio of its super low rates.
Right.
Second, and maybe more critical now, is the interest payment burden. That $892 billion, projected to hit $1.2 trillion a year by 2030, maybe 4.5% of GDP, assuming moderate growth and rates are on 4 or 5%. This starts to really crowd out other spending, defense, infrastructure, education, which was about $1.7 trillion total discretionary spending in 2024.
And some sources you included, like at Wall Street still, worry interest could soon cost more than defense.
Yeah, that's a potential milestone that really grabs attention. And if rates went higher, say 7% by 2030, interest could blow past $1.5 trillion, maybe 6% of GDP. That really ramps up the fiscal crisis risk.
Okay, so debt to GDP, interest burden. What else?
Economic growth is vital. If the economy grows fast enough, the debt burden shrinks relative to everything else. You'd need maybe 4% nominal GDP growth to stabilize a ratio with 4% deficits, but the CBO sees deficits staying higher, 5-7%.
Why are deficits projected to stay so high?
Structural issues mainly. An aging population means rising costs for Social Security and Medicare. Those are mandatory spending programs. And finally, there's the monetization inflation risk. If the Fed has to buy too many treasury bonds, it risks inflation. If money printing gets excessive, velocity could spike, boosting inflation and making borrowing even more expensive. Hyperinflation, though, probably unlikely unless global trust in the dollar collapses, because it's still the main reserve currency, about 60% of global reserves, per Forbes.
So where's the tipping point, according to the material? When does it become truly unsustainable?
The tipping point is basically when interest eats up too much of the budget or the economy. The CBO baseline sees interest hitting maybe 20% of all federal revenue by 2035. That's up from 14% recently. Manageable, maybe, with tough choices. But in that high interest scenario, we mentioned 7% rates, interest could top $1.5 trillion, over 6% of GDP.
And the risk then is?
Well, default is seen as unlikely because the US can print dollars. But as critics like Peter Schiff point out, that path risks serious currency devaluation. Think Venezuela, maybe not as extreme, but that kind of risk.
Okay, so the big question. Based on all this analysis in your sources, when might we actually reach that unmanageable point?
All right, let's break it down by time frame based on the material. Short term, next 5 to 10 years. Unlikely to be unmanageable. The sources suggest the US can still service its debt through maybe 2035, thanks to dollar demand and Fed flexibility. If growth is modest, stay 2-3%, and inflation stays around 2-3%, the interest should be manageable, even if it strains the budget.
Okay, manageable for now. What about the medium term, say 10 to 20 years out?
That's where it becomes possible. If deficits stay stubbornly high, over 5% of GDP, and interest rates climb or stay elevated, the analysis suggests interest could hit 25-30% of federal revenue by 2040. That's when really painful choices likely become unavoidable. Big entitlement cuts, major tax hikes. Forbes notes investor confidence could start to wobble if debt keeps growing much faster than the economy over that period.
And long term, 20 plus years.
Without significant policy changes. The material suggests it's likely the debt becomes unmanageable in the long term. Entitlement spending is projected to hit 15% of GDP by 2050. Add rising interest costs on an even bigger debt pile. You could see interest hitting really unsustainable levels, maybe 8-10% of GDP. Especially if global demand for the dollar weakens, perhaps because countries shift more towards crypto or gold.
Are there ways to avoid this or push it further out, mitigating factors?
Yes, the sources list several. Obvious one. Significant policy changes, bipartisan deals on taxes, spending, entitlements. Hard, but possible. Another is a sustained economic boom, maybe from AI boosting productivity, getting growth back to 4-5% like the 90s.
Well, tech saving the day.
Possibly. Or the Fed could choose to tolerate higher inflation, say 4-5%, to inflate away the debt's real value. But as Perplexity suggests on X, that risks bond market revolts and Trump's crypto reserve idea. Too early to tell. Untested impact on overall debt.
And could AI simulate this debt scenario specifically?
Briefly, yes. The sources suggest AI could use historical data like the 80s high rates to model outcomes. It could simulate what happens if investor confidence drops, maybe a 10% yield spike, pushing interest over $2 trillion by 2035. It could also forecast different inflation paths, like 7% inflation doubling nominal GDP but crushing real wealth.
So the bottom line from the material seems to be unlikely, unmanageable short-term, possible medium-term, likely long-term without reform. It really comes down to that rising interest burden forcing tough choices, austerity or monetization, which risks inflation and devaluation.
That's a good summary. Growth, policy changes, maybe new assets could buy time, but those underlying structural spending issues make long-term unmanageability a very plausible outcome if nothing significant changes.
Wow. Okay, that was a serious deep dive. We really pulled apart some complex threads there, thanks to the questions you send in and all the detail in that source material.
We definitely covered a lot of ground, didn't we? From, those fundamental debates about the Fed going back over a century to the speculative but maybe plausible world of strategic political moves between figures like Musk and Trump.
Yeah, and then plunging into AI, potentially simulating a whole new economic futures, and finally landing on that very real, very large challenge of the U.S. national debt.
What really stands out, I think, looking at it all together, is how connected these things are, even if they seem separate at first glance. The future of money, the system's reliability, the politics around it, the actual fiscal limits, it's all intertwined.
We've seen that radical change carries huge risks, according to your sources, that public fights might hide other strategies, and that while the immediate debt picture seems, well, manageable-ish,
yeah.
The long-term view really demands serious attention and probably some very difficult choices down the road.
Absolutely.
It really makes you think. As technology like AI keeps advancing and global dynamics keep shifting, how adaptable are these fundamental economic structures we rely on? And maybe more importantly, what trade-offs are we actually willing to make as things evolve?
That's definitely something to mull over as you continue exploring these really critical topics.
Thanks for joining us for this deep dive.